All right, now I'd like to welcome to the show Matt Cole, CEO of Strive Asset Management. Welcome to Free the Economy, Matt.
Hey Richard, thanks for having me.
So you've been in this world of finance, investing, asset management for a long time, and we always try and get a feel for where our guests have come from career-wise to get where they are today. Can you just give us the sort of elevator version of how you got from a young person interested in finance to the dizzying heights of CEO?
Yeah, it's been a wild ride and not a ride that I could have forecasted at all. But I grew up in Northern California. My parents were law enforcement officers. Most of my family, my uncles worked in public service as in the law enforcement field and had their pensions tied with CalPERS, the California Pension Public Employees Pension System. And so I went to school as a finance major. My gift in life was math. And so as I was thinking about where to go, I was thinking about becoming a finance professor, ultimately graduated right in the middle of the great financial crisis, which as a finance major is probably one of the worst times in history that you could possibly have graduated. But saw the underfunded pension crisis play out in a very personal way to me, right? Where my family's retirement was at stake. And so I wanted to help fix that. And so I chose to join CalPERS in their investment office for my career, try to help fix the underfunded pension crisis for those who served California, obviously personally, my parents and my uncle and my grandpa. And so, I rose through the ranks. I ended up becoming their youngest portfolio manager with really a fiduciary driven mission, which frankly was shared by almost everyone of my colleagues at CalPERS. And one of the things that was part of the interesting learnings there was, day one there, I learned that investments is political. CalPERS had been forced to divest from tobacco stocks. It cost them multiple billions of dollars, and the investment staff notably pushed against that from happening, but it was pushed down from a political board. And so the investment staff was not happy. So I didn't feel like I was out on an island versus my colleagues. No, I felt like there was a unified disagreement with what the political board had pushed down upon us. That ended up changing in the late 2010s as ESG really started picking up steam. And through certain hirings and continued board pressure, you started to see a deeper and deeper fiduciary push to focus on political values over simply maximizing value. And it kind of gets into this stakeholder capitalism model, right? Where it wasn't like there was some complete shift away from making money, but it was implementing these left leaning political values into the process of making money, and it confused everything. And it was a massive fiduciary breach, ultimately led me to Strive.
That's fascinating because Strive's website, for example, talks about having how you and the firm are part of the shareholders first movement, and so that for people who aren't really invested in this topic and haven't been like reading and thinking about it a lot, that may surprise them to think, well, of course, shareholders are first. Shareholders own the company, right? But I think you've already sort of led into the idea that even though CalPERS is an unusual situation because it's sort of it's a government entity, but in general in corporate America over the past several years, there seems to have been an odd to a lot of people sort of drift away from focusing on shareholders, and I wonder, how do you talk to people who are sort of confused by that? Because if there's one thing that people can rely on, it's that, oh yeah, big companies always serve their shareholders first. That's their whole raison d'etre, even if they, shortchange other other people, they're always going to serve the shareholders first. How do we get to a point where that wasn't the case?
Well, you have to first start that it has not been the case for decades in Europe. Europe, for since about the 1980s, most countries have adopted a stakeholder capitalism model once Klaus Schwab popularized it there. And so we've seen a playbook where you confuse social and political values and prioritization of customers and employees versus the shareholders and how that plays out, right? And how that's played out over the last 40 years is a massive lowering of returns for European companies relative to American companies. Over about over 3.5% per year over the last 40 years. That compounds to an over 2,000% difference. And so if you think about that as an investor or as someone saving for retirement, it's the difference between being able to have a secure retirement and not having a secure retirement. So that's what we're talking about here when we talk about stakeholder versus shareholders first. But in America, the shift away from the shareholders first movement into more of the European model really picked up and gained steam after the great financial crisis. And I think it's because the everyday American felt like this system was broken for them. And for some rightful reasons, a lot of it I think comes back to crony capitalism and the government bailing out certain companies that shouldn't have been bailed out in ways that don't protect or help the everyday American. But they see this problem and they develop a dislike for the quote unquote greedy corporations. But the answer is not to move towards the European model. That's a model of suffering for all Americans. The answer is actually to, in my view, to remove the crony capitalism and actually move more towards a more free market system. But that's how this has really picked up steam. And then it really, really picked up steam to me in the most surprising way in 2019 when the Business Roundtable statement was adopted that claimed that shareholder primacy was outdated. And for me, I was at CalPERS at the time, and it was shocking to me to see 181 American CEOs sign that declaration calling shareholder primacy outdated. It was then that I realized what we were really fighting against and became compelled to try to spend my career to fix it. And I think the good news is I think the winds are shifting back in a major way in America right now.
Well, yeah, that's what I was going to say myself, that in the sort of the new second Trump era, we've seen both in the lead up right before the election and then in the past couple months, we've seen shareholder focus really seems to be coming back to corporate America, with a lot of major companies making big announcements that have been, headline after headline about dropping climate commitments and DEI policies, race-specific hiring and promotion quotas, things like that, that they had previously endorsed. So going back to say like the summer of 2020 and BLM protests and George Floyd debates, and then the last few years, companies trying to sort of hitch their wagon to the Paris Climate Accords and climate change treaties and all that. Those policy pronouncements, whether about climate or DEI, came out really strongly. And then they seem to have sort of, died with, not with a bang, but with a whimper, sort of, without too much fanfare on the part of the companies themselves. So I wonder if this pivot we've seen in the past, say, just 6 months, does that suggest that the commitments of these big companies to things like climate and DEI policies weren't actually that deep to begin with?
I think for a lot of companies, the answer is yes. And so this has been part of the learning of my journey. So when I was at CalPERS, you would have name your major asset manager, a BlackRock or a Carlyle. You keep going down the list that would come in and talk about how deeply they agreed with these commitments. And then when I joined Strive, something really interesting happened. And that's that as we're talking to executive leadership across major S&P 500 type sort of companies, the most common response that we got back was, we actually really agree with your view of the world. We agree with that capitalism's great. We agree with meritocracy. We just can't say those things publicly. And so that was kind of an aha moment of what this house of cards was. That yes, there are true believers, and you can point to true believers in executive positions out there, but for the most part, most executives were going along, and I would say paying the ESG and DEI tax for their companies
Mhm.
to not get canceled. They were definitely afraid of being canceled by the woke mob and by the large asset managers that were pushing this into their companies. That okay, we'll adopt it. They accepted it, and implemented it as part of their executive pay, which to me is one of the biggest problems. Is that if a CEO, and last year we had a high watermark, 75% of CEOs in the S&P 500 have part of their executive comp tied to ESG and DEI. And at that point, it's show me the incentive, I'll show you the result. It doesn't really matter what you agree with, you're going to implement it, or otherwise you don't get paid. but I don't think that there was a legitimate agreement for most CEOs. And so I think they're trying to figure out how to roll back some of this stuff. But I think we still have only a minority of CEOs in this country that are willing to boldly stand up in contrarian positions versus a mob of people. And I think that's, part of the problem that led us here. But once you had a handful of people, and Strive was obviously one of the leaders in this, but you see people from different positions, from political positions, stand up and say, no, this is wrong. This is a fiduciary violation. And then you start seeing some legal cases break that actually show legitimate legal risks for companies to implement affirmative action policies and breaking, values over value. Then I think the house of cards starts to crumble in a very quick way.
Yeah, and I think one of the things I've heard in over the past few years debating some of these issues is that there's a real kind of, even if we think it's flawed, there's this sort of strong ideological argument for things like, climate and DEI policies that there's no, or at least was not previously, a good alternative to. So the idea being that companies and CEOs need something to hold up and say, look, we're doing this good stuff, right? So besides just, buying and selling goods and services. And the sort of ESG, environmental social governance crowd, was good at saying, here's this thing. We're going to hand you this binder, and all you have to do is hold up the binder at press conferences and point to it and say, look, we're doing this good stuff, and then you'll get credit for doing good stuff. And most people won't really care about the details. And so when it came to say, oh, you should abandon this good stuff you said you were doing before, which we've figured out isn't actually that good, they would say, well, what are we doing instead, right? We can't just say we're renouncing the good stuff and now we're not doing anything. So the I think part of the answer to all of this is coming up with a sort of, traditional American capitalism, equality, meritocracy version of whatever they were doing before that was flawed. And so the example that comes to me is, you pointed out a lot of CEOs now have, part of their compensation is, or not even below CEO level, part of their compensation is determined by the diversity of the workforce rather than the, competence or value of their workforce. And I think it would be easy enough to pivot to what a smaller percentage, but some companies have, which is to say, well, the CEO's pay is determined in part by employee satisfaction in general, right? Every year we have an employee satisfaction surveys. Lots of companies do that. And if employee satisfaction goes up from 87 to 89%, then you get your bonus as the CEO. And we don't have to implement any divisive, controversial racial hiring quotas in order to do that. I wonder, have you thought about that, or in any of the sort of engagements that you've had with companies to say, look, I know you're looking for something, for some gimmick about why you're a great company. Instead of doing this destructive, controversial thing, how about you do this other reasonable thing instead?
Yeah. So that idea sounds reasonable. I would worry about the implementation of these things because it's really hard. Because imagine this. Imagine you're a company that went all in on a DEI, quote unquote, woke agenda over the last 5 years. And because of that, you had certain employees that hated it. Maybe they left. You had certain employees that you started attracting because they were drawn to that. And then you unwind that, your employee satisfaction is likely to go down, actually,
Mm-hmm.
because you've kind of self-selected for that. And so sometimes my view is that depending on where a company is in its journey, implementing a meritocratic capitalism, maximize shareholder value process could be unpopular amongst your current employees and still be the right direction for your company. And
Mm-hmm.
so that is a rational thing, but I think if that ends up sending a bad signal because the company has already lost its mission, then that becomes something that could push them back into DEI and ESG because they're trying to maximize employee satisfaction amongst a group of people that have a lack of first principles understanding of how to build a profitable business. And,
Mm-hmm.
and so I think you have to set a foundation foundational framework for how to maximize value. And I think you have to do it unapologetically. Like, I mean, I think if you were to take the federal government employees with Doge right now, you think their employee satisfaction has gone up or down as a whole under Elon Musk? I think it's probably gone down because they have to go back to work. They're concerned about their future job prospects, but yet it's the right thing for the federal government. And so, I think it's difficult to take, in my view, an employee satisfaction survey too seriously, and it gets back to the shareholders first mindset that stakeholder capitalism, you actually elevate the employee. Not to say employees aren't important; they're extremely important for a profitable company. But if they've been elevated to the same level as the shareholder, and then you move them down a notch to put the shareholder first, as fiduciary duty says you should do, you probably lower employee satisfaction in the short term. And I just don't, I wouldn't want that to be a negative signal that stops what needs to be done in many corporations.
Oh yeah, I mean, I guess it has to do with setting the right baseline to begin with. So and looking sort of pulling back into a wider view here about why some of the stuff we're talking about is problematic. Um, it's in it's possible to have just an ideological view of things and say I just don't like these. I just don't like these policies. I don't like race conscious hiring and promotion policies. I think we should have pure meritocracy, and it's possible to disagree about those things in a free society. But I think there's also plenty of specific, tangible problems that come with this outset that we maybe haven't completely wrestled with in politics and in public affairs. And so, sometimes people will ask, well, what's the harm in introducing some of these environmental and social issues into investing and even in government policy? I think some people they sort of vaguely think that they're kind of a gesture in the direction of fairness and that they don't really hold back anything important. They're just sort of like the land acknowledgments, before an event at a university where, we acknowledge the Native Americans who lived on the land before us. But I think a lot of this has much more problematic implications. And you wrote, I think it was about a year ago, an op-ed that I thought was very interesting with a great, very specific test case, which is the Chips and Science Act, the bill that passed by Congress to create more domestic U.S. microchip manufacturing, both for economic reasons and national security reasons. And so, that op-ed read in part, I thought, interesting snippet here, said, commentators have noted that the Chips and Science Act money has been sluggish. What they haven't noticed is that it's because the CHIPS Act is so loaded with DEI pork that it can't move. How did that happen?
Yeah, so it comes back to if you set goals that are near unachievable with regards to hiring to get money, then you can't do it. And so there was all sorts of different pork in this on hiring on the basis of gender, on the basis of race, to give money to disadvantaged communities. And if you really think about it, to build a modern day chips manufacturing operation, specifically a fab and developing some of the most advanced chips out there, that is hard. This is hard to do. And it's specifically hard to do in America where 90% of the most advanced chips in the world are actually developed in Taiwan. So you're going to take something that's actually extremely far away from America, you're going to bring it into America, and you're going to do it with excellence. That has to be the full focus. It's like trying to build a pro sports team with massive constraints and try to compete in the NBA with against a bunch of males, but you have to hire a bunch of female basketball players. Like this is not gonna work. And it's not because there's not talented female engineers that could do great, but I'll give you an example. When I was at CalPERS one time, I was told that my next hire must be a female. Okay. Like I was told in verbally, not in writing, of course, because it would have been foiable. We get about 100 applicants. 5 of them were females. I had to cut out 95% of the applicants and then search from a small pool. Just the odds, forget who those 5 people are, the odds that the best candidates in 5% just because of on the basis of a gender or race means that we're likely not hiring the best people. Well, this was the same thing with the CHIPS Act and an engineering, most engineering talent happens to be males. It's just fact and nothing wrong about that, but to make all these restrictions made it impossible. And so they weren't able to meet the requirements to take the money. So they kept delaying. And that's why we wrote that article about DEI killing the CHIPS Act, is that I think there was pretty bipartisan support for the desire to bring chips manufacturing back to the United States. And when you start layering in all this pork, you risk missing the goal to achieve some political goal. And that's what we saw. And I guess one more point though, just to go back to a point you talked about, is that they it's often said, well, these things are good. And it's important to call out that that's extremely debatable, and likely most of your audience would take the other side. I would take the other side, that if I'm hiring on the basis of gender or race, that's racist and sexist hiring practices, and it's bad. It's actually a bad thing that that introduces and causes divisions in society over the long run versus a colorblind and a gender blind process and pure meritocratic process that I think ultimately brings people together over the long run. But obviously, other people might disagree with that, but you can't just accept the argument that these things are good. You actually have to debate that. And regardless of what side, so I take the other side of that, but I think we have to agree in this country that even defining what is good is extremely debatable, and it's extremely controversial because of the political differences in this country. And so that brings us back to the first principles: hire the best person, remove all values and focus on value. So Strive doesn't try to focus on turning companies conservative or Christian, even though I'm a conservative Christian myself. That's not the point. It's remove politics from corporate America.
Right. And so now, we've got a big change in leadership, like I said, in DC in general, but also specifically at the Securities and Exchange Commission. The SEC certainly got a lot of criticism from conservatives, libertarians, small government people, however you want to define them, for some of its aggressive policymaking and rulemaking, including the very big climate disclosure rule that required public companies to report a long list of information about climate change and energy use and board management and all sorts of things. Now that we are in a different era now, and the SEC recently announced that it would not be defending the climate change disclosure rule in court, and so it seems like that one, for example, might be on its way out. What, as someone who's really deeply involved in the finance world, what are you thinking or hoping will happen under a new SEC, other than just less of what happened under the Biden team?
Yeah, so obviously less of what happened under the Biden team. And just to hit on that climate disclosure rule for a second, one of the things that was always just telling of what this would do to corporations was to see what the consulting class was doing to prepare for this. And PwC was spending $8 billion to prepare to help corporations. That's one consulting firm. And if they're investing $8 billion, that means that they're going to charge public corporations a lot more than $8 billion, right? That's the opportunity that they saw to help companies comply. And there's obviously many different consulting companies. And so this is going to be a massive tax and a massive constraint on corporate America and on profits ultimately for American citizens. So I'm glad to see that roll back, but it's not a healthy environment to have such massive changes in regulations every 4 years or every 8 years, as you have one president come in and one president come out. I think what's happened in this country and what gives me hope that it's much deeper than that is two things. One, the conversations that we've been having with CEOs behind closed doors, that they haven't actually agreed with a lot of this stuff to begin with. I think that most Americans do not like these values pushed into corporations. And there was actually a study that we've been pointing to since day one at Strive, where it was I think it was Brunswick Group, but a consulting group asked everyday Americans, do you think corporations have a role to play in social issues of society? And they asked everyday Americans, and then they asked managers in corporations. And two-thirds of Americans said no, corporations shouldn't be involved. 2/3 of managers said yes. And I think that shows the managerial class versus everyday American problem. But Americans don't want this as a whole. Yes, there's a subset of Americans, and it's a lot of individual people, but it's a minority of Americans that want this. But we don't set policies that are going to cost Americans money based on a minority of Americans. And so I think that this move back to corporations being corporations is going to have lasting impact. And I think that the technological change that's happening in society right now with AI advancements is going to make it significantly challenging to roll back in 4 years or 8 years or 12 years down the road if we have a change in administration, because I think it's true that what Elon Musk says, that we're going to have 100 years of innovation in the next 10 years. And so if you think about the next 4 years as what would typically happen in 40 years, you move a train in a certain direction for 40 years, that's going to be hard to roll back.
Mhm. Well, yeah, I mean the other thing about some of those surveys about attitudes about corporations and American business and big business, um, there are as you point out, there's plenty of results that where Americans will say, "Oh, we really don't want government. We really don't want corporations wading into these sort of like government type policies. They should be neutral." But even when you find one that does sort of suggest that a majority of Americans would like corporations to do something having to do with environmental policy or social policy, those are always kind of a one layer question, which is, oh, should corporations do good stuff on social policy? And so, 70% of people say, yeah, corporations should do good stuff on social policy. But there's no follow up saying, well, what should they do, right? Given the fact that we're a pretty polarized country on a lot of political issues, I suspect it's very likely that of all the people who said corporations should do something on social issues, half of them want them to do one thing, and the other half of them want them to do the exact opposite thing.
Exactly. Yep. Yeah. And so then if you take that and say, okay, maybe 2/3 say we want them to do quote unquote good, 35% view good as one thing, 35% view good as another thing, and then 30% just say don't do it at all,
Mhm.
then I think it's pretty clear of the only way to get people on board is to not do anything at all, because it's the least painful, and it's also the right fiduciary version of the world, right? Where especially for large companies, I do think that there's small companies out there that can be values focused. I just think that for the largest publicly traded companies in America, the answer is value over values, and then leave values leaning companies, whether it's Christian company or some left leaning values company, to small business, because that's ultimately what the size of that business should be.
Mhm. Right. I know. Uh, Again, one of these examples of potential policy direction moving from the Biden team to the Trump team, we we still have a legacy of a lot of policies still on the books. We still have a lot of people working in the executive branch who were implementing those old, Biden era policies when it comes to finance and investing. And one of these that I think has been particularly controversial that we've talked about here on the show before is the bias against crypto and cryptocurrency investing. So the Biden team never had a hard announced policy that we're anti-crypto, right? Um, but by bank supervision and different regulatory actions, they have acted to try and crowd cryptocurrency investors out of the market to push them out of the financial system in what is called Operation Choke Point 2.0. Back, in the Obama era, that we had what was ended up being called Operation Choke Point, which was bank regulators coming in and trying to get controversial small businesses, whether they were like gun shops or payday lenders or whoever, trying to like get their bank accounts canceled. And now we've had over the past few years a lot of people talking about there's a crypto focused version of this Choke Point 2.0, trying to get big banks and financial institutions not to do business with crypto investors and developers for whatever prejudicial reasons they dislike the crypto world for. As Strive is now focusing a lot on cryptocurrency and Bitcoin investing, Where do you see this going forward? Do you think we've turned a corner on sort of anti-crypto hostility from the regulators?
I think we've turned a massive corner, and just to put a pin in what the old administration was doing and why it was so troubling. Obviously, debanking, all these things are not good. But the most frustrating thing about this was that it was an environment about regulation by enforcement with no clear rules. And so imagine you're in the cryptocurrency industry, and there's time and time again true stories about these things that are detailed, and I'm sure you probably covered some of these things where people doing business in crypto would reach out to the regulator and say, I'm thinking about doing this. Can I do this? And they would say, read the law. No answer. They wouldn't give you an answer. So you would read the law and you say, I think I can do this because the law doesn't tell me I can't. So then you do it, and then you're immediately hit with an enforcement action or you're debanked. And that process of we're not going to give you any clear yes or no answer of what the rules are, but as soon as you do something, we are going to shut you down and we are going to debank you and we're going to, fine you. That is corruption. And that is corruption and that is a complete anti-crypto policy and in the worst way. It's actually worse to do it that way than to set a clear rule that I would have disagreed with that could have been anti-crypto, but at least then the cryptocurrency industry could say, okay, there's a clear rule. I want to do this, but I clearly can't. Maybe I'll go do it in some other country, or I won't do it. But to be there was no need for this enforcement actions against the cryptocurrency industry. That was to me the most frustrating thing about the Biden administration. And so with the Trump administration, I think what's going to happen is it's going to be clear rules and clear rules that are favorable for the crypto industry. So I think that's the best version of the world is that first and foremost, the crypto industry just wanted clear rules. Even if there are rules that they might disagree with, at least they know what they can and can't do. And that's a completely reasonable ask. But I think it's going to go one step further and actually be rules that will drive innovation to America. And I think one more point on this, because I think it's important that a lot of the reason why we've seen innovation in crypto in the ways that we have, and so right now we kind of have this meme coin mania that I think's dying. But why do we have meme coins? Because meme coins are one of the one clear things that aren't a security that kind of fall outside of this regulation. And so this lack of clarity has led to bubbles in the crypto industry in ways that would never have happened, in my view, if we actually had clear rules. So I think the Biden administration is directly responsible for some of this unproductive innovation in crypto that I think wouldn't have happened if we just had clear rules.
Oh, that's a fascinating counterfactual. So I was just recently at a investing conference in Las Vegas, and a lot of people were talking about where the market's going in 2025, big macro trends. A little talk about policy, kind of a little less than I kind of thought there would be actually, policy changes in Washington, D.C. But everyone wanted to know what's the hot sector, what's the hot tech stock, where should I be buying? And so even though we're not giving financial advice, I just want to sort of sound you out, and if you think there's a kind of growth opportunities if we're in a deregulatory space, policy-wise, and I think with Trump and Doge, we definitely are. We'll have to see how far it goes. Does that mean then that there is a sort of Trump trade opportunity where previously overregulated industries are going to like take off now? So we talked if we end Operation Choke Point 2.0, and then there's opportunity in crypto maybe. If there is a drill baby drill America first energy policy, maybe there's energy sector possibilities. What do you think about that?
Yeah. I think the clearest trade is Bitcoin. And so I think when you think about mass deregulation from an overregulated previous stance, I think there's a chance that you might see some short-term mania pop up in different parts of the market. I think that's actually rational. But I think those things will ultimately be short-term in nature and die. But what won't die is Bitcoin. And I think that Bitcoin's biggest risk was actually regulatory risk. And I think that's been near completely removed with Trump winning. And so Bitcoin itself, Bitcoin related investments like corporations that put themselves on the Bitcoin standard, I think is the clearest trade, both from deregulation, but also AI. I think AI, when you think about it, everyone knows AI is massively innovative and it's going to disrupt all sorts of industries. But predicting which companies will be the winner in the AI boom, I think is actually extremely, extremely difficult. But I think it will point to a digital future and a digital future that of which Bitcoin will likely be a winner in. So all signs to me point to Bitcoin. It's our number one investment theme. And I think for us, from an investment perspective, our biggest three things are Bitcoin, AI, and energy. But AI is less clear how to actually invest behind outside of Bitcoin itself.
Hmm. All right. Well, Matt, this has been an excellent conversation, and I think will teach our listeners a lot. So before we go, where should people find you, find Strive, if they want to rush to you and give you all their money to manage? Where should they go?
Yeah, so Strive's website, strive.com. We're also very active on X. So I'm at Cole Macro, and then Strive is at Strive Funds.
All right, excellent. Thanks for being with us, Matt.
All right, thanks, Richard.